Stock market volatility has returned recently, in part driven by Omicron and also by recent comments from US Federal Reserve. First, on COVID-19 variant Omicron, it's certainly too soon to tell the full impact, but what these types of events tell us at a high level is how much the financial markets dislike uncertainty. For example, last Friday when this news broke, we saw the US stock market decline about 2.25%. That was the largest single day decline since February of this year. Now, since last Friday, the markets have been swinging up and down by more than 1% each day. These levels of price swings in a row haven't occurred in over a year. In fact, it was around the 2020 elections and the time when COVID-19 vaccine announcement was made when we last saw this many days of larger price swings. Now to the Federal Reserve. Comments from the Fed this week, Fed Chairman Jerome Powell shifted to a more hawkish stance on monetary policy from a dovish stance. Now you might be thinking bulls, bears, hawks, doves, it's a lot to keep track of. Let's discuss hawks and doves and what this means. First off, this relates to monetary policy, which is about the money supply. This is different than fiscal policy, which is about taxation and government spending. Now recall that the Fed has two mandates: control inflation and maximum full employment. Importantly, the efforts by the Fed to manage one versus the other don't always line up evenly. This gets to the description on hawkish versus dovish. A monetary hawk focuses on keeping inflation low as a top priority. On the flip side, a monetary dove prioritizes low unemployment levels over inflation. Why is this important and why are the markets reacting? Well, the Fed has been focused on improving the labor market for some time. During this time, interest rates have been kept low and money has been injected into the economy. This has led to increased levels of inflation. The Fed pivot recently to being more hawkish means keeping inflation in check is now the top priority, more than maximum full employment. To some extent, this is the Fed announcing they are needing to control inflation more, which could lead to more swift bond tapering and possibly sooner than expected increase in interest rates. Increasing interest rates is how the Fed can cool down inflation. As you can imagine, changing from being dovish to hawkish sets new expectations for the market participants, and likewise, more uncertainty. Now let's set aside all reasons for why the stock market may experience volatility and talk about volatility from a historical context. To help tie this all together, let's also assume that increased market volatility is synonymous with uncertainty. First, market volatility and uncertainty is normal. Stockholders broadly are rewarded for this very reason, accepting uncertainty to share in the potential success or results of the company in the future. Now let's talk about how often the market experiences increased volatility and declines. To help with this, we're going to use a chart on historical data. Now you may find it interesting to hear that over the past 41 years, on average, the stock market experiences intra-year declines of about 14%. That means that at some point during any given year, the market on average has a decline of about 14%. Again, that's the average or normal. Now, despite the market having intra-year declines, the market has generated positive results for the full calendar year 75% of the time. Now, to help explain, let's take a look at some specific time periods. First, in 2020, the US stock market had an intra-year decline of about 34%. This occurred from February to March. However, the market still finished positive 16% for the full year. If we back up even further in time to the great financial crisis of 08 and 09, we find that intra-year decline in 2009 was 28%, but the full year return was positive 23%. Now, resetting back to current year, we find that the biggest intra-year decline for the US stock market this year is about 5% through yesterday. Despite the uncertainty of Omicron and Fed policy, we haven't had that much of a decline. And the markets are still very much positive. In fact, they're up about 22%. So what's the takeaway in all this? Well, stock markets are uncertain in the short term. Volatility can spike higher in a moment's notice. We certainly know that stocks will have negative years. This exercise is to help us understand what has occurred from a historical perspective to help us make more informed decisions today. Now, I want to leave you with this picture we came across recently. It's well suited for what we've been experiencing in recent days. At times, we may think or hope that moving from point A to point B is a smooth and steady line. As we know, this is rarely, if ever, the path for the stock market. The path is often one of varying peaks and valleys. Uncertainty in investing is more than a possibility, it's expected, which is why we need to plan for it.